Hello, everybody. Hi, everyone. Hi, happy Monday. Another week on VCTV. And I'm back this week to discuss about a very interesting topic that I spoke and I hosted it last Friday. It's about SPAC, a special purpose acquisition company. So we have new set of speakers who are going to share their experience about SPAC investments, pros and cons, difference between SPAC and IPO, because obviously with a SPAC you need a target company, obviously, and you go public. A private company goes public. So just let's discuss about fundamentals, the pros and cons of a SPAC, and some use cases as well. So here we go. Happy Monday. Hello. Welcome back, all of you, again on this episode of VCTV. Good morning, Raghu. Good morning, Peter, dialing in from US and UK. And good afternoon, Vandana from India. Then we have Gary as well. So yeah, let's have a quick round of intro. Before that, just want to do a quick intro myself. My name is Sunny Mohanty. I'm the regional director of LaToken based here in Singapore, and I host VCTV. So that's me. That's VCTV. It's a platform to connect investors like yourselves with budding entrepreneurs who are looking to raise funds, looking for connections, looking for networking as well. So this is the right platform. And thank you for being a part of VCTV and coming back on VCTV again and again to share your valuable knowledge. So yes, let's start with, who do I start with? Okay, I'm going to start with Vandana. Vandana, hi. How are you, and how I hope you're safe in India. First of all, to let us know you were safe there.
Yeah, I'm pretty much safe here. Hi, Sunny. Always nice to see you, and very happy to see your happy energies always. And thank you for having me here. I'm safe by the grace of God, but the situation here is not really good.
Right.
And we pray that everybody, we can rescue more lives and save more lives here, and pray for everybody's well-being over here, because there's a lot of things happening here. Otherwise, I'm pretty much safe.
That's good.
Very happy to see Gary, Peter, and Raghu, and I'll happily introduce myself now.
Yeah.
I was in Singapore and Jakarta for 15 years in investment banking. I had my own family office fund there, and this is my 7th year back in India. I did some investments, then I went back to advisory. So currently I'm connected with 300 investors globally, and I do pick up global deals. Our ticket size is $1 million to $25 million, and we are sector agnostic. So I'm happy to see you all.
Okay, we have got a viewer, and he's happy to see us all. Thank you, Vandana. Thank you for that intro. Welcome back. Then I have Raghu. Welcome back.
Thank you, Sunny and LaToken. Always a pleasure to be here, my esteemed panelists. And I'm a serial entrepreneur, angel investor, and strategic advisor from Princeton, New Jersey. I look for impact investments in biotech, green tech, cybersecurity areas mainly.
All right, perfect. And always glad to have you on our panels, and good to know about your exit as well, the recent one that you shared. And yes, it's going to be a rocking panel. Gary, how are you today?
I'm good. I like when Raghu said the esteemed panel. I feel like we're in the Oscars. I was waiting for his acceptance speech. So, it's a great to be here. Great to see familiar faces. My name is Gary Fowler. I'm a serial entrepreneur and investor. I've done 17 startups. I've had 2 unicorns. I was on the original management team at Click Software, sold to Salesforce for $1.35 billion, and also Eva.ai, an AI tech company that I co-founded 5 years ago. I love AI, and I'm actually writing a lot about impact investing. Actually, my next article on Forbes is my next article is on quantum, but then I have an article on African startups after that. trying to make a little dent in the universe. What else? I write a lot and love being on these panels, and it's great to see the entire VCTV family and some familiar faces and friends.
Same here. We're always happy to have you, Gary, in this family because you're the main member of this family.
Well, I'm the main member. I feel like I'm the. We have a phrase, Dutch uncle. It's a guy that sits in the back seat when the car goes.
The esteemed Dutch uncle.
Yeah,
esteemed Dutch uncle.
I need one of those little trophies now.
Great, awesome. This is what we love about VCTV, all the energy and the smiles and everything else. Thank you so much, Gary. Raghu. Next, we have Peter. Hi, Peter. Welcome back. We just spoke on Friday. How are you?
Good. I know we had a little bit of, I thought we had a conflict today, but I'm so glad we were able to connect. It seems these days I only can speak to and see Gary is on these shows because he's just so busy. See, he's even busy now. And in terms of Raghu, I've been looking for my Oscar trophy, but I just can't find it. Not even the little plastic one I got from Disneyland. But in any event, the Weimer Family Office is a multi-family. It's a multi-billion-dollar family office. We focus on investments around the globe. Our minimum size typically is 150 million to several billion. That doesn't mean that the only projects we invest in is 150 million. We could do things from million to 5 million, but obviously depends on the management team and the technology and what we're speaking on. In the last, I would say, year since the pandemic, I've been much more focused on real estate, in particular, green tech, clean tech, ESG, and how AI could be helpful, and the other technologies surrounding the hospitality and real estate industries, most importantly. And then, talking about family, Sony, Gary and I become dear friends, and look forward to doing some stuff on a collegiate basis as well. So thanks for the opportunity, as always.
Wow, that's such a fantastic news. Gary, Raghu are working together on something, and Gary, Peter are working together on something. Vandana and Gary obviously are working together.
It's a family affair. Come on.
It is. It's like VCTV family office.
It looks like the Brady Bunch on the screen, so
Here's a story.
Right. So great. Great. Thank you so much for that intro, and the collaborations that you're making is fantastic. And I just love what's happening through VCTV. So today we're talking about, again, SPAC, which companies are great targets for merger with SPAC. We obviously touch upon such topics where people show a lot of interest to understand what is a SPAC, what are the pros and cons of SPAC, difference between SPAC and IPO. Hence, we sort of bring those topics again in the week. Just to educate people, share the knowledge from the experienced panelists. So hence we are back with the same topic today. So yeah, so let's start with this whole thing about SPAC. I mean, let me just share my screen a little bit. So we have this. Okay, so we have this. So these, I was scrolling through, and we have, like in 2020, top performing SPACs of the year, published on December 21st, 2020. And there were like a long list of that. Quantum Space, DraftKings, Iridium, Immunovant, Betterware, Adapt Health, Switchback, MP Materials, Repay, Open Lending. So yeah, there were a lot of I just want to stop share. So obviously, as we saw, there are a lot of SPAC deals that were closed in 2020. So my first question would be, what made 2020 the year of SPAC? Was it the pandemic? Was it the forced digital transformation that we had to go through because of the pandemic? What was the reason? Raghu, let's start with you.
Sure. I think pandemic was the primary reason, but there were a lot of other things. The SPAC activity has started kind of increasing all the way going back to 2013. Every year it was kind of increasing, and 2019 actually had quite a bit of SPAC activity. But obviously, a lot of the more esteemed people got in to the SPAC in 2020. So it became more mainstream in 2020. So I think, but pandemic was, I think, the reason that a lot more people got in now. There were actually more SPACs in 2020 than traditional IPOs in specific cases. And as you know, there's more than 100 billion already kind of raised using SPACs. Although about a few days ago, there was a change in the accounting regulation, which classified SPAC warrants as liabilities into equity. So it has put down a little bit of downer. The activity has gone down briefly. And we have to see in the long term how it goes.
Okay, all right. More to come on that as well. Thank you, Raghu, for those opening remarks. Gary, over to you, please.
Yeah, so I mean, Raghu's right on target. The pandemic has helped really propel it forward, and their companies, because they haven't been able to go through the traditional routes, have really picked up on the SPACs. And having done an IPO and going through that arduous process, it takes a long time, and to be able to do it in a shorter period of time with a lot of the same effect is really important. And there are companies that are just trying to, they want to get out to the public markets, and it's a shortcut in a positive way to be able to do it. So, and again, SPACs have been around in one way, shape, or form for a long time, for years. So it's it's just like any type of market. There's a lot of people get started in the beginning. Not a lot of people knew about it. Now it's becoming mainstream. They're filtering all the SPACs that didn't make a lot of sense. Now the SPACs that really have teeth, the right kind of teams, the right kind of board of directors, the really ones that have the meat that are going to come out and rule. We're particularly interested in artificial intelligence and cybersecurity. So there hasn't been as much attention from my perspective paid to them. And we're going to see those and quantum computing really start to take off.
Perfect. Thank you, Gary. Next, Peter.
Thanks, Sony. So just to reiterate what Raghu said, and then to follow up on Gary's comments, we spoke at length on this on the same show last Friday. Here's the situation. The SPAC space has been an asset class, as you know, Sony, for a number of decades. Okay. It became much, much more prevalent over the past year, not because of the pandemic. That was one of the catalysts, but the reality is liquidity. The entire global financial system has been aflush with liquidity, leading asset managers and others trying to figure out how to tap into that liquidity in the most efficient and time sensitive way. And the best way to do that is to use the public markets to take a company public through that of a SPAC. And that's because the SPAC is easily to be registered with the SEC, on NASDAQ, Dow Jones, or others, etc. So you limit the amount of paperwork and time that a blank check company or a shell company would have versus a company that would have years and streams of audited financials that would need to be filed, etc. So the process time for registering a company is quicker with a SPAC. So I think that's an important thing to highlight. It's just a quicker time, more efficient, but doesn't change the methodology, which is fundamental analysis, fundamental analysis, fundamental analysis. Who's driving that SPAC? Gary mentioned the AI space. If we have leaders, industry leaders that are creating a SPAC to then identify a company over the next 12 to 18 months to be part of that SPAC or to acquire that SPAC, what does that basically mean? That means you have industry leaders, a great management team that's going to be involved in looking to acquire a company that in the public capital markets would have a more efficient means for capital for their continued growth. If the company is operating quite well in the private markets, it makes no sense to have the regulatory scrutiny by investors and the SEC, FINRA, and others. So the most important thing is Does the target company need to access capital markets? And if so, a SPAC is an easy way to do that. But at the end of the day, the management of the SPAC, the management of that private company has to be able to operate under the public and regulatory scrutiny that's available once a company is public. And now, lastly, I know I probably used up my time limit. In terms of the market and any time is now differentiating between the winners and losers. The winners are the ones that have the great management teams and are able to execute on the acquisition of a private company or many private companies, and those that are not able to, and also the companies that they're looking to acquire, making sure they are able to be robust in the SPAC public sector model. So we are starting to see the differentiate between those winners and losers over the last several weeks as the euphoria to going to the SPAC now changes into a more fundamental analysis. And I think AI and technology with the proper leadership is a great way for SPAC to take many companies that are private public.
I think great points, Peter. Access to liquidity besides the pandemic is a great point to highlight here as well. And besides whatever you just explained, I think my next questions are about that as well. But anyways, it's okay. Vandana, thank you so much, Peter. Vandana, over to you, please.
Yeah, am I audible?
Yes, you are. You are.
Okay. So, SPAC, a special purpose acquisition company, is a business that is created with the sole ambition of merging with another company to take it public.
Yeah.
SPACs, also known as blank check companies, have no commercial operations but use money raised from public to fund a takeover or merger of another company. They are usually set up by investors and sponsors that have a particular area of expertise and want to explore potential deals in the sector. SPACs do not usually reveal precise targets, but often signal a specific industry and region that they are focusing on. Now, in 2020, SPAC made up most of the growth in US IPO market compared with the year ago level. SPAC raised $79.87 billion in gross proceeds from 237 counts, surpassing the record of $13.6 billion raised in 2019 in 2020. The average IPO size was $337 million. The 462% year-over-year jump in proceeds raised by SPAC in 2020 outperformed the traditional IPOs, which is basically why 2020 was termed as the year of SPAC. And personally, I think this title is premature because we are not quite 4 months into 2021, and yet, US SPACs have already raised more money than the record of $83.4 billion that was raised in all of 2020. And, so I feel like this is why the year of 2020 had, maximum number of SPACs.
Yeah, great. Thank you so much, Vandana, with that. So my next, I think, we've just understood now with the first question itself, with the opening remarks, basically, we've understood the concept of SPAC and why did it pick up during the pandemic, especially during last year. So let's move on to the next question to understand how is it different from the SPACs. As all of you mentioned over here, SPACs has been there for a long time already. It's nothing new. But what is different? What's the difference between the SPACs, probably 10 years back or 20 years back, and the SPAC that happened in 2020? What are the fundamental differences? Let's start with Raghu.
Thank you. I think the difference is that now there's a lot of energy in that space because of the pandemic. Like a lot of people are getting in, and the investors, especially a lot of retail investors, have gotten into it. As I said, it became mainstream. But again, I think the performance of the SPACs, the actual after the demerger happens, how they were performed, we still don't have a lot of data because a lot of the SPACs have happened in within the last 18 months, and we have to see how the performance goes to see really where it goes. Again, the SEC and is going to kind of drive some of the things, and I think the recent ruling requires a lot of the SPACs to restate, and also not just at the beginning of the launch of the SPACs, they have to do every quarter, because once the warrants become liabilities instead of equity, then you have to kind of restate it, calculate it, just like stock options are, which is not a big burden, but right now I think looks like that's put a damper. In April, suddenly it fell from March. There's a pretty steep fall in April so far. It may be just a little blip. We have to see. So I think overall, it's a great vehicle for companies that are high growth, forward looking, which may not have the traditional track record. The traditional IPO, you need to show at least 2 years of track record, past performance, whereas the SPAC, they may be just more futuristic, forward-looking statements, and is great for new technologies which have like a lot of potential impact, which and very strong teams. And the good thing about the SPAC is that you get a partner who might get you the governance framework and the people with the right experience, whereas traditional IPO takes some time to build up that kind of team inside the company. And there is a transition here. I think that there is a team to help you through that transition, assuming that team is going to stay on at least long enough to kind of help you make that transition.
Yeah, sure. Thank you so much, Raghu, as well. I just wanted to share something very quickly. So as Raghu said, so despite the SPAC, so as Raghu rightly said, despite SPACs, so venture capital has had a huge start to 2021, but has run into some problems lately. SPAC growth dominated the space, but has cooled off amid regulatory pressure and poor performance. So let's just discuss that as well. So next is Gary. Gary, how are the SPACs different now from the past, and so what's the future? Because we just Raghu just mentioned as well, and we just read this article as well. The SPACs have gone down because of poor performance. So what does the future hold for such investment models?
Well, Sunny, a lot of it is, it's like the ICOs were some time ago, right? There a lot of things came out, but let's go back to the fundamentals. You've got a performing management team, you got a board of directors that performs, and you've got a company that's really in a hyper growth stage, ready to come out. So if you add those elements together, the chemistry is right. So, and it's the problem is sometimes we get so involved, we become irrationally exuberant and start to invest in everything. It's like the Dutch tulip phenomenon. So we need to go down through and we need to really focus. And SPACs have existed a long time. Even though we've only recently talked about them, over the years they've changed structurally. So what do you say? What are some of the differences? In the early stage, it was common practice to disclose the target company under strict, NDAs. But today, it's really, the reason was an investor could really decide whether they want to keep their investment or redeem their shares and not really move forward. So they could really, rebel. And today it's changed because the modern SPACs now have the right to redeem their shares regardless of a vote, making sure there are no interruptions in the deal. So it's really a much smoother deal flow. So if we look at, some of the recent rulings, the warrant rulings, et cetera, I mean, there are changes taking place. And again, the good news is that there's an appetite in the market for the SPACs. There's an opportunity, but we've got to go back to the fundamentals, or as it would in any kind of a market, it'd fail. I remember we did an IPO in NASDAQ, a Click Software, and we went down through the process. It took about 9 months, by the way. It was not a lot of work with the SEC, et cetera. So, It takes a long time. I believe that the SPACs succeed. It's just a matter there'll be those changes, and we're looking at it. The warrant ruling's only been a couple of weeks old, and I know that folks are going down through and reevaluate it and figuring out how they can comply properly.
Right, sure. Great points, Gary, over there as well. Peter, I think you have explained most of the things. I just want to ask you a little different question. How do you compare the typical SPAC merger timeline with the traditional IPO timeline?
Well, just a couple of things, just to backtrack too. I think it's important in terms of the question, in terms of how does SPACs differ from today versus prior years.
Sure.
Over the last several decades, like anything else, we've seen an evolution towards going the nuts and bolts, industrial type of companies that were traditionally acquired through the SPAC model, to today's model, which is obviously focused on anything and everything, that has a proper management team and a proper fundamental and analysis that leads to proper operating performance and growth. So any industry can be used by a SPAC format. Remember, a SPAC is a means to an end. It's a structuring process. It is not an actual investment. A SPAC is not an actual investment. If you want to break the backbones down to a SPAC, one of the safety part of SPACs for a retail investor is if the management team fails to identify a company or companies to acquire, the money is invested that they put into treasury bills or treasury bonds. So your capital is returned. Your full capital is returned, which is something that's very different than investing in a startup IPO. So here it's about the management team being able to execute to acquire a situation, otherwise the capital is returned. Now, it's unlikely that any capital will be returned if something can be identified in the next 24 months, let's say. So I think that's a very important situation to understand. The second thing is in terms of the timeline. As I mentioned, the timeline is a lot quicker with the SPAC simply because you're not having to file. Private companies probably don't have many audited financials, or at least not financials that are up to par to SEC type of filing rules, nor have they reported to shareholders before. So they haven't had their accounts ready for that. So if you have a company that's getting ready for an IPO, a good portion of the battle is preparing management and the team and the accounting and the lawyers, etc., for a public listed company. Whereas with a SPAC, you have a blank check company. So it's a lot easier to get that filed and in a much quicker fashion. And then that company goes off and acquires a private company. Now, that's easy and more efficient in terms of registering versus an IPO. However, that private company going forward is going to have to file quarterly and annual reports, SEC compliant, and have the proper staff in place that's familiar with a public company versus a private company. So again, it's more efficient initially, quicker initially, but going forward, it's no different than any other company that's a public company. And as Gary mentioned and Raghu alluded to, it's all about management, having a good team in place and being able to execute on a business strategy.
Great points, Peter. Thanks for clarifying the difference. It's not an investment, actually, a tool, actually. So thanks for clarifying that as well, because people do confuse between that. Vandana, yeah. So how do you see it being different?
Yeah, so it's like, how fashion changes and something new trendy comes in. I think SPAC is the new trend now. So everybody wants to get into it. And but we do have to look at facts here. That is, we need to have an appropriate management team and we need to do some hardcore analysis. We also, have to make sure that do they have the experience to do this or not. And, it ends up to be quite expensive if we do a SPAC. We need expertise in the execution as well. Now, the main advantages of going public with a SPAC merger over an IPO are a possibility of raising additional capital. I mean, SPAC sponsors will raise debt or private investment in public equity funding in addition to their original capital to not only fund the transaction but also to fuel the growth for the combined company. Also, there is faster execution than an IPO, and a SPAC merger usually occurs in 3 to 6 months on average, while an IPO usually takes 12 to 18 months. And
Right.
upfront price discovery, your IPO price depends on market conditions at the same time of listing. Whereas you negotiate the pricing with the SPAC before the transaction closes, so which is much more advantageous in a volatile market. And then there is the possibility of raising additional capital, like I mentioned earlier, as well. That SPAC sponsors will raise debt or a private investment in public equity funding in addition to their original capital to not only fund the transaction but also to fuel the growth for the combined company. This backstop debt and equity are intended to ensure a completed transaction even if some SPAC investors redeem their shares. Then, of course, there are lower costs of marketing. A SPAC merger does not need to generate interest from investors in public exchanges with an extensive roadshow. Although raising PIPE involves targeted roadshows. So I feel like, there is a difference there.
Right. Thank you, Vandana. I think there was some issue with your, I could hear some echoes, but yeah, I think it's resolved now. Thank you so much.
Okay, okay.
Can everybody hear me? Am I clear? Great. So, yeah, thank you. Thank you, Vandana. Thank you, Gary. And thank you, Peter, for sharing those with us. The differences between how SPACs were done before and how has it evolved in 2020 and 2021. So let's talk about technology. We cannot keep technology out from any sort of investments that has been made in the recent times as well. So we are here because of technology. So how technology helps companies in the SPAC process? So what is the contribution of technologies in the SPAC process? I'm going to start this with Raghu.
Quick clarification, Sunny. Are you talking about the technology to launch a SPAC and demerger, or are you talking about technology companies going to, going through the SPAC process?
The former one.
Okay. I think the technologies are already in place because SPAC is there have been reverse mergers and IPOs happening forever, and this is just a combination of that with a few additional rulings that compliance wise. So I don't think that there's a lot of new additional technology that's required for a SPAC. I think it is more of being able to track how things happen going forward, because we are now at the point of 18 months since some of the larger SPACs came in and the large number of SPACs came in as well. So how efficiently the demerger process happens and these SPAC companies that went public, how they kind of evolve and perform, I think is going to kind of give us a better idea of how popular SPACs will be going forward. It may become, another vehicle for certain types of companies. Right now, as Vandana mentioned, it's more of a fad now that everybody's talking about SPACs, but it may become more targeted for certain types of companies and also for certain areas where you really need a heavy expertise to come in right up front, like for instance, space tech and things like that, which are harder to raise, traditional IPO, which are more futuristic, and more forward-looking. So I think it will evolve into, it's obviously another way to raise capital with advantages and disadvantages. And I think it will evolve into where the ideal type of companies that, go through that vehicle will be clearer. I think the other thing that is happening, I believe, is that international companies, like for instance from Singapore or from India, since the SPAC is still not come to all the other places, they are probably good targets to get acquired by SPACs because it's harder for them to list in a US or some of the other markets where SPACs are right now popular.
Right. Thank you, Raghu. Thank you so much. I'm just, I thought probably you froze, but it's okay. Thank you so much for that. Raghu, sorry, not Raghu. Thank you so much, Raghu. Gary, over to you, please. Sorry about that.
You threw her sideways, Raghu, by just not moving. Anyhow, so the one thing you were asking about the technology, Sunny, and because of the digital transformation over the last year, being able to use Zoom to be able to conduct the meetings and do SPACs and situations and not having had a physical meeting with folks and yet being able to conduct business. I mean, that's a huge quantum change. And, fortunately or unfortunately, we started to accept that that's a normal course of doing business.
Yeah.
So you don't have to fly to New York for a meeting or to California to sit down and talk about the SPAC. It just, they get done virtually. So that's a big change, and it's much more efficient and effective. But at the same time, you got to do a lot of due diligence, the same type of due diligence that need to be done to make sure the characters and everybody that's participating are the right folks, and they pass the litmus test. So it's just changed. It's faster and more effective, and our society is going to continue to adapt and continue to move faster as these technologies start to be adapted, as the Internet of Things starts to come on board, as AI starts to become more part of our life, and quantum computing. So it's just part of the natural course.
Absolutely, Gary. Thank you so much for answering that. Next up, Peter.
Yeah, so I'm going to echo Raghu and Gary's thoughts. But one very important concept that I think is important is the SPAC model, again, is simply a structuring vehicle that's more efficient to get things to market quicker. Okay? Doesn't change the fact that at the end of the day, if we're talking about the U.S., one of the largest capital market, it's there to protect the individual investor, not the institutional investor. So on that basis, okay, all the I's need to be dotted, all the T's need to be crossed. So the actual regulatory portion, making sure that's all done, is not quicker. So as we stand right here today, there is a certain means to an end. There is a certain time frame just from start to finish, legals, technicals, regulatory wise. But once that SPAC, that's all been crossed off, then the management of the SPAC can be very efficient in terms of going out and looking for target companies. Obviously, they have to have the management team that's capable of executing on that. Where I think technology comes into play is just the natural evolution. Hopefully, over time, and particularly given the de-SPACing process, or the practice after a company has been acquired, the demerger process, you might say, the technology will enable for more efficient filings and stuff to get into the public domain. It might allow for a smoother process in terms of technology-enabled AI helping in that matter, in terms of distribution of information to stakeholders, those stakeholders being the key stakeholders, or it could be retail investors, etc. So that's important. I think AI could also be helpful in terms of making the process more efficient in terms of time to market, in terms of exchanging documents, reviewing documents, etc. I mean, we could just look at the advent of DocuSign, for instance, makes things more efficient. So that's helpful. These Zoom type of calls that we have, or Teams calls, are also helpful in terms of getting lawyers and accountants and management team together. There's no reason you could be on the slopes in Zermatt or Aspen or whatever. You could still get on a Zoom chat and be quite efficient in terms of getting things to market. So I think that's most important as well.
Absolutely, nailed it right there, Peter and Gary. The importance of technology, in the SPAC process. I mean, thank you so much for sharing that with our viewers. Vandana, over to you if you would like to add something to that.
So, Sunny, technology keeps changing every 6 months, and I think we have to be proactive and progressive in, picking that up. You remember when first time we were on streams, how many times we crashed out, and we had so much fun as well. So, I think, even when Zoom came in, everybody was like, "Oh, I'm not going to go to Zoom. What's that?" And then suddenly when pandemic hit us, everybody had to use Zoom. There was no other choice left. So I think eventually when we are forced to do things, we do it very fast. So I think it's better we start adapting to new technologies, and definitely, SPAC will come in to play, and then we have lots of new technologies coming up. I had a few other things to, add if I could, add them. The way SPAC works is that they list on exchange like the New York Stock Exchange, and then typically have up to 24 months to acquire a target company. If a deal isn't made by the 2-year mark, they must dissolve and return the gross proceeds to shareholders. Since SPACs don't make anything or own any assets, it's the founders that are the main, draw. Investors may bank on founders having the right connections to close with a hot tech startup and bring it to the market. In other words, it's a case of betting on the founders, rather than the company. And it must be noted, however, that the New York Stock Exchange didn't bother listing any SPACs until May 2017. In fact, just 5 years ago, Goldman Sachs had a strict policy against them. But today, the junior Goldman, bankers are issuing, complaints of grueling working conditions due to the boom in SPAC issuances. So you can really see how quickly it has grown in the past few years. And, EVs and other green tech, clean tech sectors have been widely popular with SPACs. That's because while those sectors have some of the traditional public market metrics which investors typically see, and they also fit the criteria of SPACs love, and high growth with the significant long-term potential, and light detection and ranging technology for autonomous cars and 3D printing could be attractive, as they are the type of forward-looking businesses SPAC often desires. And software, social media, and quantum computing are likely will be looked at by SPAC also. Cybersecurity could attract some attention too, in my opinion, and it is a growing sector and a hot topic right now. And in my opinion, fintech, direct-to-consumer technologies, healthcare tech also will be eyed by SPAC due to their growth projections. And basically, any industries that have public-ready companies and high growth projections are targets for SPAC and must not be overlooked. So,
Yeah.
this is my small take over here.
No, thank you so much, Vandana. You've covered technology, you've covered the target companies as well, target industries as well, which is a great thing. Absolutely.
Yeah.
Thank you so much for sharing that. So we have 15 more minutes. I just want to know about some regulatory requirements for a SPAC merger compliance. So what are the regulatory requirements? We're going to start with Raghu.
Yeah, so the SPAC, like I said, the regulatory requirements, some of them are changing, but it's kind of like doing a reverse merger, but the IPO ahead and then the reverse merger. In a traditional reverse merger, you take a public shell and then you reverse merge into it, the private company. Here, the IPO happens and then the target, is they search for the target and then to the reverse merge. So it's a little bit different in that sense, but the regulatory requirements are pretty much very similar. In fact, that's part of the ruling that SEC did recently. They're saying that the de-SPACing process is like a traditional IPO, the similar compliance rules, which there was a perception until now it's a little faster and a little cheaper. Yeah, it is probably faster because there is a better governance team. But in terms of actual, the compliance, the SEC is kind of coming back and saying it is like a traditional, the demerger process, like the second step. The demerger is like a traditional IPO from a compliance perspective. So I think the complexity is more in the initial stage because there is this trust funds, the funds that are raised from the public are put in a trust, and I think Peter was alluding to, there is the opportunity for them to either rebel and take their money away if they're not happy. So that part of it is new compared to what was there before, and I think it is not totally understood how because they usually use $10 as kind of the price, right? The price. So it is not totally yet understood is that how much of that is actually going into other costs and all that. There is like some people are saying around 10% of that is there is some you're not really getting the value at the $10. It's really like $9. And I think as it evolves, it might actually go different where there may be better ways to estimate how the performance is going to be on a SPAC based on different other metrics. I think that part, because it is more forward looking, it's still not as well established as an IPO because the target piece is missing, and it's only we just have the jockey, not the horse, essentially. So I think that will happen, especially if they give more guidance.
Great points, Raghu. Thanks for sharing those points with us. Next, I have Gary.
Yeah, I mean, they covered a lot of the points, so I don't want to just rehash it. But the situation with the SPAC, so I don't want to go down through the trust fund, et cetera. We know that needs, but it's the compliance. Having gone down through the IPO process myself, it's just the overlook. When SPACs really started to become mainstream, the SEC, like the issue with the warrants, had some different opinions. And now, as the rules start to come in place, these SPACs need to be either be compliant, or in the past become compliant. So those are some of the issues. But again, having gone down through that process, it's an arduous. The normal process is arduous. And you're not going to skirt the law. The law is the law. You just have to comply. The good news is there are a lot of SPACs and a lot of groups have come out with multiple SPACs, so they know how to get them out quickly. So that's that's all from my perspective. Other points were covered.
Right, absolutely. Thank you, Gary. Thank you, Raghu. Peter, would you like to add on to whatever Raghu and Gary just mentioned about the regulatory?
I think it's important to summarize basically for your audience in terms of what is the kind of 3 phases in a SPAC's lifespan. It's not just like anybody could just start a SPAC, issue some statements to the SEC, and boom, now I've got a publicly traded company. Now I'm going to go acquire whatever the hell I want. It doesn't work that way. There's a very formal process that's very typical IPO in its terms. There's a filing of a registration statement with the SEC. There is a clearing of the SEC comments. There's an undertaking of a roadshow. There's followed by a firm underwriting commitment. So what are those phases and what's the time frame? The initial IPO phase, you have to gauge a corporate counsel. You have to engage auditors. You have to incorporate a SPAC, okay? And then you have to distribute the founder shares. You have to prepare an S1 or registration statement for the SEC. It has amendments. The SEC comes back and gives you comments on those amendments. Then you negotiate underwriting and other agreements and stuff. Then you do a roadshow. Then you price the deal. Then you close the deal. That's phase 1. Phase 2, now we got to target a company to potentially purchase. That could take 18 to 24 months. Okay, what is that? You have to look at, first of all, you got to periodically put out SEC filing statements for the SPAC as it stands right now without any company. So you're a publicly traded company. So you have audited financials that need to be presented. Now you got to go out and find a business to target. You have to do due diligence on that business. You can't do that yourself. You'll probably hire a Goldman Sachs, a Bank of America, or somebody like that to help you with that due diligence. Then you have to prepare, is it going to be equity financing, debt financing, combination thereof of acquiring that company? It's not necessarily going to just all be equity. That doesn't make any sense. Equity is the most expensive form of capital. Then you have to identify, do the due diligence, you sign the acquisition comments. The shareholders have to vote, as well as the board, on acquiring that company. You're a publicly traded company. You can't just go out and buy whatever the fuck you want. I mean, you have to have shareholder approval. That takes time. Then we go into phase 3, which is basically you announce the acquisition, you file preliminary proxy statements, offering documents, discuss it with the SEC, etc. Then you finally close. This is a time-consuming process, no different than an IPO. The only difference is that the structure is a little more efficient because you have a blank check company at the outset. Everything else is a long and arduous process, like Gary mentioned, and that doesn't change. You need proper management to execute properly on a SPAC, and then after the acquisition occurs, to make sure that that company can continue to perform well so that shareholders benefit from an uptick in their share price. Otherwise, everything goes to pot.
Thank you so much, Peter. I just wanted to add something. I really like the energy you, with the kind of energy you have, and you just stressing on the life cycle of a SPAC. I mean, I was like really enjoying your speech as well. That level of energies and have energized me as well. Thank you so much for sharing that. I mean, this is very clear now, to me at least. For anybody who's new to SPAC as well, will understand. Thank you so much, Peter, for explaining that so nicely. Vandana, over to you.
Yeah, I think Peter covered almost all the points and, very efficiently here. And I think there's nothing much to be covered by me over here. Definitely a lot of due diligence is required. We need the proper team. And also, there has to be a proper execution team. And there's a lot of analysis that needs to be done when we pick up SPAC specifically. But I think if we are not thorough with it and not experienced with it, one should not put hands in it. Only when you are sure that, the person who's executing it is really, really efficient, then I think we should go ahead with it. So I think Peter has really covered all the points. There is something which the government of India, which I would like to, there was some act in 2016 when the government had announced demonetization. Then there was a suspicious shell companies that have been cracked, and there has been an urgent need to define them because they are not currently defined under the Companies Act. And a parliamentary committee urged the government to describe the word shell corporation in the Company Act in order to avoid legal uncertainty and discourage avoidable prosecution. Unfortunately, the SPACs have no company objectives of their own, and their only goal is to achieve a target. So I think, the Corporation Act in 2013 repealed that the other objects provision, thus eliminating all flexibility in the description of the objects. That means the business amendment ordinance passed in Parliament in 2017 recommended that the abolition of altogether objects provision. However, this idea has been removed. Since the object clause is required and SPACs do not carry an objective clause, it might contradict the regulatory framework in India. So I think, we need to be careful when we pick up projects here. So there is some...
So SPAC deals are not very popular in India?
No, not very popular.
Okay. Good to
but in Silicon Valley, they are.
Yeah, Silicon Valley and Singapore as well.
Sony, Vandana, I would just like to add one thing. I think it's important. The U.S., look, I'm sitting here in London, but and have been for over 20 years. The U.S. market is the deepest and broadest and most efficient capital market in the world. And if you're going to give a management team, I don't care if they're the best of the best to breed, a blank check to go out and acquire any company they want. Okay. I have enough problem with that in terms of investing in a U.S. company, giving that much responsibility to a management team, particularly since SPACs are not focused so narrowly that they basically say, we're going to go out and buy a healthcare company that just makes widgets to support hospitals, and within the hospital, a certain knee operation. No. They're made sufficiently broad so you can pretty much acquire anything if they, despite their mandate saying we're going to invest in technology. It could be any technology, it could be anything. So you're giving a lot of breadth to management with a lot of responsibility. If I'm going to invest in a SPAC, I want to make sure it's in a capital market that's deep and broad and has the proper regulatory authority. And that's going to be in a Western democratized type of capital market. That's going to be in the U.S., maybe on the FTSE, maybe on the DAX, etc. Is it going to be on the AIM? Absolutely not in the UK. Too much penny stocks traded there, and certainly not in developing countries at this stage. It's just too much responsibility. It goes back to my initial comments. Management. That's what you're investing in when you're investing in a SPAC. Can management execute on the acquisition of a company, and then after that, acquiring that private company, continue to make that company more investable and create value than if it just remained a private company?
Yeah, I totally agree.
Wow,
Totally
that's a
agree.
very good point. That's a very good point. It's not for the developing countries. Thank you so much.
Yeah.
Okay, good to know. I mean, I wasn't aware about that. So great. Thank you so much, Peter, for adding that on to this panel. I think we are having great comments as well to this topic, and people are asking more questions. I'd just like to know if you have a next SPAC session, what else would you like to speak about? I mean, obviously, this is a 1-hour session. Anything else you like little bit different you like to speak about, Raghu?
Sure. I think one of the things we did not address is about the motivation for the founders versus the target, right? Because the target is coming in and moving forward into the public, whereas the founders are kind of getting their exit at the demerger. So it's a little bit different than a traditional IPO where everything is aligned. So that is something I think companies that are using SPAC as an exit vehicle have to consider carefully how much of the founder team they need and who's going to continue and all that kind of thing. That's a good topic for another session.
Absolutely. That's a subtopic, and we're going to talk about this on our next SPAC panel, and I hope to see you there, Raghu, as well.
Absolutely.
Gary?
Yeah. So, what's in it for everybody? How does everybody win in the SPAC? I think that would be good. So what's as Raghu said, the acquisition team, the founders, how do the sponsors make money? I mean, what does it look like?
Absolutely. Peter?
I don't think you hear.
Yeah, no. Hello. I was talking to myself here because I put it on mute. So I'll have to repeat what I was saying to myself. My wife's always telling me she hears me talking to myself. What am I talking about? So, so I'll continue what I was talking about. I think what's in it for management? Again, it is just a more efficient, and I know I keep repeating myself like this, but it's a quicker time to market, and therefore they're hoping that their rewards will be quicker, but that's not necessarily the case. I think what's also important here is that if management has a blank check to go out and buy companies, okay, with a very broad mandate, okay, that's something that they don't typically get in terms of just taking their company public. And so why does this work so well for a private equity company, an activist investor, okay, or a VC for that matter? It allows them to have discretion that they otherwise wouldn't have that discretion in terms of going out and finding a company or a portfolio of companies. And I think that is the most important monetary consideration, because in the end, with that type of discretion, they're able to hopefully identify targets, acquire those targets that they might not be as easily available to. And not only that, if you have an activist company investor that's looking to take a company public that has traditionally been private, and they just don't like management and stuff, okay, this could be a good way to help take that company acquire that company in the public domain. However, again, you still need shareholder approval. Okay, so you
Right.
don't have carte blanche.
Right. Thank you so much, Peter, for adding that on. Great points there. I'm going to include that for next session, and I'm going to see Gary, Peter, and Raghu again, the team. Vandana, what extra or what would like to see, like to obviously be included in this panel?
Maybe the developed countries could educate more to the developing countries about SPAC and how to collaborate so that we can take this segment further, and also the risk factors involved. I think
Yeah,
maybe
I
we
was
should,
about to that. Challenges faced by developing countries.
yeah,
Back to you.
so that we can be careful as to what we are picking up and how we need to, work towards it.
Absolutely. That's a great point. That's a great topic to discuss under the SPAC
Yeah.
topic itself. Thank you
Yeah.
so much. That again is a very informative, very, very informative session today. Peter, I like your energy. I'm going to have you back on my other sessions as well. Just love that energy is infectious. And Raghu, very informative as well. And Gary always smiling and very supportive of VCTV. I feel a lot of energy support from Gary as well whenever he's there. And Vandana, again, what can I say? we are friends outside of VCTV as well. So yeah.
So anyway, I just have to tell you, the reason why I'm more animated today is because I'm on a strict diet from my doctor and my wife that I'm not allowed to have sugar. I'm not allowed to have carbs. So the only thing I could have is tea and coffee. And I've been just drinking that and Red Bulls all day, although Red Bull has sugar, but don't tell anybody. Well, that's why I'm a bit more animated than usual.
Oh, got it. Gotcha. Right. But we love that energy. All of you agree, right? Thank you so much, all of you. And I'd love to see you back on another SPAC topic. We're going to drill down about on each of the points that you've highlighted. And we'd like to know more and share more as well. Having said that, thank you so much. I'll be back again. This is the start of the week. I feel like, I don't know where probably end of the week, but that's how VCTV makes me feel. So I'll be back tomorrow again on another episode, another topic, another set of speakers. Most likely see most of you, some of you there also tomorrow on another episode. Till then, please stay safe, India, and others stay happy and safe as well. Who never know where the virus goes next. So I'll see you again and take care.